Hey there, everyone! Welcome back to our channel. I hope you're all doing well. Today, we're diving into a topic that can help you keep more of your hard-earned money in your pocket: tax loss harvesting. Now, I know that taxes can feel like a complex maze, but don't worry. We're going to break it down together in a way that's easy to understand. So, grab your favorite snack, sit back, and let's get started. Now, you might be wondering, what exactly is tax loss harvesting and how can it benefit me? Great question! Let's unpack this concept and see how it can work for you. So, first things first, what is tax loss harvesting? Simply put, tax loss harvesting is a strategy used by investors to reduce their taxable income by selling investments that have lost value. By selling these losers, you can offset capital gains from winning investments, thus lowering your tax bill. To illustrate this, let's say you have two investments, one in a tech stock that has gained $5,000 in value and another in a biotech stock that has lost $2,000. When tax season rolls around, you can sell the biotech stock to realize that loss. This means you can subtract the $2,000 loss from the $5,000 gain, resulting in a taxable gain of only $3,000. This could save you a significant amount in taxes, depending on your tax bracket. Let's use a practical example to make it clearer. Suppose Jane is a savvy investor. She bought 100 shares of Company A for $50 each, which is a total of $5,000. Later, she purchased 100 shares of Company B for $70 each, totaling $7,000. Fast forward a few months, and Company A stock has skyrocketed to $100 a share, while Company B's stock has dropped to $50 a share. If Jane sells her shares of Company A, she realizes a profit of $5,000. However, if she sells Company B at a loss of $2,000, she can offset her gain. So, instead of paying tax on the full $5,000 profit, she only pays taxes on $3,000. This is tax loss harvesting in action. But here's where it gets even more interesting. The IRS has specific rules about this. If you sell an investment to realize a tax loss, you can't immediately buy it back and claim that loss. This is known as the wash sale rule. If you do buy back the same stock within 30 days, the IRS won't let you claim the loss on your taxes. So, if you're considering tax loss harvesting, make sure to keep this rule in mind. Now, you might be wondering, how much can tax loss harvesting actually save you? The answer varies based on your situation, but let's look at some numbers. According to a study by the investment firm Betterment, tax loss harvesting can increase your after-tax returns by as much as 1% per year. While that may not sound like a lot, compounded over several years, it can make a significant difference in your investment portfolio. Let's break it down further. If you invest $10,000 and achieve an average annual return of 7% in 20 years, you would have about $38,000 without tax loss harvesting. But if you were to implement tax loss harvesting and boost your returns by that 1%, you could potentially end up with around $46,000. That's an extra $8,000 just from being tax savvy. So, how can you get started with tax loss harvesting? Here are a few practical tips. 1. Monitor your investments. Keep an eye on your portfolio throughout the year. Look for investments that are underperforming and could be sold for a loss. 2. Consider your tax bracket. If you're in a higher tax bracket, tax loss harvesting can be especially beneficial. Make sure to calculate how much you could save based on your potential tax liabilities. 3. Consult a tax professional. Tax laws can be complex, and it's always a good idea to consult with a tax advisor or financial planner. They can help you develop a strategy that's tailored to your specific financial situation. 4. Stay informed. Keep up with changes in tax laws that may affect your ability to harvest losses. The IRS regulations can change, and it's crucial to stay updated. In summary, tax loss harvesting is a valuable tool for investors looking to minimize their tax liabilities while maximizing their returns. By strategically selling off losing investments, you can offset your gains and save money on taxes. Remember to keep an eye on the wash sale rule and consult with a tax professional for personalized advice. If you found this video helpful, please give us a thumbs up and subscribe to our channel for more educational content on personal finance and investing. And if you have any questions or experiences with tax loss harvesting, feel free to share them in the comments below. We'd love to hear from you. Thanks for watching, and until next time, keep investing smart and stay financially savvy.